Now economists are warning of the potential for a drawn-out trade war. Canada and China have announced retaliatory tariffs already. We are waiting to hear what Mexico will do. Joining me now to talk about all of this is Marc LoPresti. He is CEO of Market Rebellion, which offers investment and education tools. Thanks so much for coming on. Eager to hear your reaction to this story. And since I started with the markets, before we get into the tariffs, what is your reaction to how the markets are responding to this, and when might things stabilize on Wall Street?
Well, Annika, good to be with you. And this has been a few days of pain. The pain really started on Friday of last week. And the primary reason for this sell off is markets are now realizing that Trump's tough tariff talk has now become a tough tariff policy, and that any hopes of avoiding a trade war are largely dashed. And we've actually seen a lot of ongoing negative commentary, even further threats from the Oval Office that things might get even worse based on how these countries retaliate, Canada in particular. Markets like certainty. They do not like uncertainty. And the uncertainty in front of the traders and investors right now is not, is this a reality? Because of course it is, but for how long? And until we see exactly how long these tariffs are going to stay in place, and does this go to a full-blown trade war, we're going to have continued volatility and continued days that end down firmly in the red.
And for how long, and what particular sectors are you most concerned about being impacted by this?
Yeah, well, listen, it's a regional story and it is a sector story. We rely so much on the materials that these countries supply for our industrial manufacturing base in this country. We think about even in New York in particular, New Yorkers expected to be hit from the city all the way up to upstate New York, places like Buffalo, where they rely so heavily on energy imports from Canada in particular, things like natural gas. You can choose, Annika, to not buy that particular discretionary good that might be expensive because of the inflation and the trade war, but you can't choose where to buy your energy. So what we're looking at right now for New Yorkers in particular, somewhere in the neighborhood, if this stays in place, around $1,200 to $1,300 a year in additional costs, and that's not making people very happy.
No, not at all. And as I mentioned in the intro, China and Canada have already launched retaliatory tariffs of their own. And the foreign ministry spokesperson for China said that China will fight to the end. That certainly isn't promising. I know you said markets don't like uncertainty. How protracted do you think, can you estimate that this thing might be?
Well, we think it's going to be for the foreseeable future. And that doesn't mean every day ends as ugly as today did and as yesterday did, because there's still a lot of strength and momentum in the tech sector, the data center explosion, which is not letting up, the AI boom that's not letting up. Smart investors, particularly institutions, tend to look to buy, right, when things are on sale. And a lot of these names, particularly the tech darlings and even the smaller cap ones, Annika, have been up so significantly, not just this year. And by the way, we have given back just about all, if not all, across the three major indices of the gains year to date, right? Sort of the Trump bump that we got from the election, certainly from the inauguration, we've given all of that back. So a couple $1 trillion in value has been wiped from the market. We do remain long-term bullish, even medium-term bullish. You have to remember what Trump is trying to do here is take a fairly draconian approach. That's part of his personality and part of his style of governing, and not everybody likes that, but taking a fairly draconian approach to create equilibrium when it comes to our trade partners. And when you think about it, if you've traveled anywhere, I'm in Mexico right now covering this tariff story, but if you go to Europe, if you go to other parts of the world, American goods, cars in particular, cost an extraordinary amount more than they do here, and the opposite is not the same. So we do have trade imbalances. We do have economic conditions in place that disproportionately disadvantage American businesses, small businesses too, including those in New York. So the hope is short-term pain for long-term gain, but until we know just how long that term is going to be, we're going to be trading in some very choppy markets. We see buying on these pullbacks where the expensive stuff gets cheap, but then those algos kick in the pain kicks in and it keeps trading down to the downside. We're looking at 5,700 as the next important level in the S&P in particular. If we start flirting with going below 5,700, we could be going down to 56. Then I start to get even more concerned.
Okay, a lot of important insight there. Marc LoPresti, CEO of Market Rebellion, really appreciate your coming on the Rush Hour. We'll see you soon.
Pleasure's mine.